If order flow information, as we mentioned earlier, it's the same data set telling everyone the same information, how can it still have an edge then for everyone? Or how can it still work for everyone?
This is a really smart question. So first of all,
Fabio Valentini. You know who he is. A world-class scalper, multi-top 5 finisher in the Robbins World Cup, an alpha researcher for multiple 7-figure corporate entities. Today, I want to learn one thing from him he's never shared publicly. How can your average retail trader build a strategy that actually works?
if you identify which trigger is the most efficient in the short term, and you use the trigger to align with the long-term bias, you have a model.
But Fabio doesn't just expose how to build a strategy. He also lays down a complete step-by-step framework to prove that your strategy actually works and how to know when to abandon it entirely.
Then you do one thing called edge contribution. So you take a different information and you put in the model. And you want to see if the quality of the signals improve or not. So you can put absorption, you can put aggression, you can put exhaustion, and you can test and see with this model of bias for this specific asset, which one works best.
Do you have a systematic way where you say, this is edge decay, or no, this losing streak is normal variance inside of the return structure of the strategy or the model that you're running?
Yes. I tell you exactly step by step how I do it.
By the end of this interview, you'll have a complete framework you can use to take a trading idea, turn it into a strategy, figure out which parts are actually adding edge, pressure test whether the strategy actually works, and recognize when that strategy has stopped working. And Fabio is even revealing one of his flagship trading methodologies live on the chart. Nothing in this video is financial advice. We're here to study how an exceptionally successful trader actually builds, validates, and executes a working strategy. Now, let's get into it.
Now, Fabio, a lot of what you do is already public. So let's say you had to personally train a competent trader. What would you be able to teach him or show him that isn't already in your public material and YouTube videos?
I will start, Brandon, with data analysis and proper risk protection. Like the biggest struggle that I had during my career was building a process that let you identify what is an actual edge, okay? And how you can manage risk accordingly. We are humans, so the problem, I think everyone has this problem, it's fighting your ego, fighting yourself. Closing the trade early when your hope tells you the market will reverse and you will go back in profit, no? Yeah. We have this behavior of changing the stop loss, and then the stop loss become bigger than the take profit, or the inability to know when it's time to stop a strategy. You build an edge. Maybe let's talk about the opening range breakout strategy. Now it's worldwide used. I use it with volume, okay? It's proven, it's audit. You can test it for yourself. You can see that there is a drift on Nasdaq. So it's not something that I say. There are proper research about this, okay? So this is an edge. But what if in 2028, when a lot of people start using it, you start to see that net commission is not profitable, okay? So all the validation side, it's what tells you it's time to stop. This strategy is not performing anymore. And everything that brings you to this level of competence, it's what you need to do before trading. Because you start executing a model when you know that what you are executing actually works. The other side is automatic the risk management, okay? For example, nowadays platform, one of these, it's a function of automatic risk manager of deep charts, is blocking the traders when you reach the maximum budget for the day, okay? So let's say that you have a trend following strategy and you are in a really choppy day. The market is consolidating, is not going anywhere. If you don't have a daily budget, you will continue to take trend following setups. And if the market stays 3 days in consolidation, you can destroy 20%, 30% of your account. But when the daily budget is met, I survive today and I come to fight another day. And this, I think, is one of the biggest takeaway for people that are starting and also for professional. Because let's separate the idea from the reality. Also, when you are trading for multiple years, specifically if you manage big capital for yourself or for third party, we are not immune from emotion. We make errors, okay? And that's the reason you need a system that is keeping you accountable for today, you had your idea, you follow your plan, you lost money, done. Go to train, go to a sauna, do something else, but don't spend another 3 hours at the chart trying to recover, because you will only make it worse.
And, Fabio, you mentioned in the beginning, the two things you would teach someone then was real risk management, proper risk management, and then also data analysis.
Yeah.
And I wanted to unpack that a little more. In your data analysis, what does this look like? Let's say you have an idea you see a new idea or maybe a new pattern or systematic sequence in the market.
Yeah.
And you say, this looks interesting, maybe it works. What does it look like going from, I see something that looks like it might work, to I'm willing to risk money on this?
This is an amazing point of view and topic that we need to cover, Brandon, because it's where majority of people fail.
Yeah.
So before I was a completely discretional trader last years, okay? And I came up to a realization that now with the upcoming AI and with all the tools that we have, it's just not efficient to spend days backtesting, okay? It's better to validate at least individual trigger, okay, with a statistics, okay? So what I do, I have 3 separate phases. The first phase, it's bias identification, okay? So I need to know on the intraday, on the multi-day, on the long term, where I'm going. I will give you a practical example, okay? On Bitcoin, to understand where I'm going, I use on-chain analysis. That is like fundamentals, but used on the blockchain data. The blockchain is public, so you can study everything. You can study what portfolio of more than 1,000 Bitcoin are doing at the moment. You can study what new portfolios or retail are doing. You can study what BlackRock is holding in the portfolio. It's all open, okay? So all this data I pull into one proprietary analysis model that I have, and I build a bias. From this level, we are supposed to bottom down. The halving, it's affecting the price, okay? So I say, I want to go long on Bitcoin. This is the bias identification, okay? Then we go to what you ask, the trigger. I need to know when to execute, no? And so the trigger, you can automate the trigger. You can see, for example, if an absorption works better than a demand, if a demand works better to be trendy than the order block, okay? If the order block works better than the value area low. All these tests can be done in 2 ways. The first way is for swing trading, considering that it's 20, 30, 40 opportunities per year, I do it manually. It's really easy. It takes me 1 weekend to go all over the setups, no? So I have my trigger there and I have my checklist. On the order flow, we are talking about hundreds, thousands of setup, no? So automating the trigger and isolating this part and watching, if I only watch at the trigger, one-on-one risk to reward, which one perform better between these 4? Already from there, you can understand which trigger is the most efficient in the short term. If you identify which trigger is the most efficient in the short term, and you use the trigger to align with the long-term bias, you have a model, actually. Okay. What's the problem with this, Brandon? That the more you go in short term, the more edge can break easily. Okay. I've been really stubborn in 2025. I was trading a model that performed amazingly during the World Trading Cup that I engaged, okay? After Trump, the market start to change. I think you notice the New York session are more compressed. You don't have this explosion and continuation. You have explosion back inside the range, explosion back inside the range. So pure trend following momentum model, like the one that I was using, started to underperform. And why I've been stubborn? Because my analysis told me, look, Fabio, don't continue to trade this because the edge, the profit factor is deteriorating. But considering that I used this model for multiple years to get amazing results, I convinced myself, no, let's try it another month. Let's try in another 2 months, okay? I could have saved a lot of money if when my data told me, look, switch this model because for the current market condition it's not working, okay, would have saved probably 6 figures. And these are all errors that bring then the trader to be able to adapt. Trader and machine nowadays work in the same way.
Fabio, so a lot of traders, what they'll do is come in with a strategy, gain some confidence in it, and then it starts losing, right? And now maybe it's edge decay, maybe the strategy never worked, wasn't properly validated. I want to go back to when you said the edge decays and it's time to turn off the strategy in that market condition.
Yeah.
How do you have a systematic way where you say this is edge decay or no, this losing streak is normal variance inside of the return structure of the strategy or the model that you're running?
Yes. I tell you exactly step by step how I do it, okay? So for the edge decay, we need to have a period of time in out of sample that is not respecting what were the results in the in sample, okay? So you should start to notice an equity line that it's floating up, starting to go sideways before. It doesn't go immediately down, okay? It goes sideways. This sideways is making you reflect on the fact that net commission, you are break-even, or you are slightly losing, okay? Or you are doing profit, but at a really slower pace. And usually I use a rolling quarter to evaluate it, okay? Like I did with the World Trading Cup, okay? As you saw, the performance are not always the same. Sometimes the strategy perform better, sometimes the strategy perform worse. And what I do, I use the 3 months evaluation, okay, with scalping. Because in 3 months, I have more than 100 execution. So I have enough data to compare 200 execution with the previous quarter. Now, if you do swing 3 or 4 execution, it can be a negative streak. But 200 execution, 300 execution that flit down, you need to stop immediately the strategy. Otherwise, if you trade another quarter, you will eat the profit of the quarter before, okay? So, and second of all, I don't trade one model, Brandon, okay? I had years like 2023 where more than 6 months, one of my model was in drawdown, a momentum model, because the market started to compress again, okay? But I don't want to tell, but I made money with crypto, with my on-chain model. I made money with models based on the intraday. I made model with the global money with the global macro. So I think the real secret here is not being dependent on one strategy only, because every strategy will meet a point where the market conditions are not reflecting your idea, okay? I think the problem of the majority of the trader, Brandon, is expectation. Is creating an idea of traders that can make profit in any market condition. The idea of 100% win rate, the idea of one strategy for life you study and you use it. I changed countless strategy during the years because I continue to improve. On the option flow, in the last years, the 0 DTE option started to account for 60% of the notional volume per day. So when the market change, when you go from a market that include the 0 DTE option and the volume year by year is doubling, you cannot ignore your data if you are a intraday trader, because this one is relevant, the hedging activity, the option flow during the day. So I needed to start to study options. I didn't want it. It's not easy for me, but I started to study options because it's necessary nowadays. And even with this, from a regulator perspective, if you tell me, Fabio, can you guarantee that using all the best model, you will make profit the next month specifically? I cannot guarantee because the distribution of return is not linear, no? It's not each month you get your salary, that's it. It will be amazing if it was like this. It will be amazing because you could predict it. But maybe you do 2 negative months, 1 crazy month that covers more than the last 6 months, then 2 break-even months, then 1 incredible. And this is the biggest message. So during the years, I understood that the secret, Brandon, is having validated edge on multiple markets diversified in a way that you smooth. They say the only holy grail is diversification. The only holy grail is diversification.
You know, Fabio, the misconception or the mismatch in expectation, like you say, where if you really get into the data, strategies do not meet what you see a lot of people say they make monthly when you get into the data, right? So what specifically are you looking at numbers-wise then to validate a strategy, and maybe that can give some people watching a better expectation to have when they're testing their strategy?
So let's start from the going against the common expectation and going against the propaganda, no? On the quant system, I have one quant system, the IVB, it's negative risk to reward. Okay, everyone say to you, go 1 to 20, 1 to 30, 1 to 40, crazy risk to reward. But you need to consider that to take this risk to reward, you will have a really low win rate. Probably you will make also profit if you are good, but you will have streak of losses of 10, 20 trades. Okay, so first of all, it's understand that the model should have not only a good profit factor, but a good recovery rate and a good equity line in terms of smoothness. I don't want to optimize for net profit. Between two strategies where one strategy make like this, big swings and arrive to 10 million of profit, and a strategy that is building consistently and arrive to 2 million of profit, I will always choose the second one, because the second one is allow me to build more capital expecting less drawdown. The first one, it's a lottery, because if I enter when it's doing the downswing, I will go probably in margin call for that account. You understand? So I don't want to say that it's not good to take some risk sometimes. I did in the bull run. I stepped the foot on the gas and I loaded heavy because I was convinced about that analysis. But I don't say that if you want to build a stable, portfolio, this is the best way to go, specifically with all your capital.
So you would say then, let's say looking at profit factor, for instance, 1.5, 1.6.
It's amazing.
Is that you would consider, absolutely amazing.
Specifically in thousands of, because look, when for example, I scalp, I have single weeks, where the single week profit factor, it's above 3. But with 20 execution, when you start to go to 100, 1,000, if you find 1,000 execution, sustainable profit factor at 4, 5, 6, probably you are making HFT, or there is an overfitting, some overfitting there, Now, specifically that everyone is vibe coding strategies, there are a lot of look-ahead bias, overfitting problems. Then you put the strategy in live market and it's not performing, But when you do proper backtesting, when you do proper testing of the strategy, you can find out that 1.5, for example, IVB is 1.4, but over 5 years of data, I find it amazing, because maybe you will not make life-changing money with one trade, but you will have this equity that in terms of Sharpe ratio beat the S&P 500, because that's the final goal, Brandon,
Do you think discretionary traders should still go through this level of validation?
I think here we will see a lot of contradiction, because I know amazing discretionary trader that use their actual market understanding, pulling multiple data. I will give you an example, no? You have a really strong gamma exposure level. You have an absorption there, You have confluence from multiple sides, order flow fundamentals and options. And you go to this guy to tell, look, you need to backtest It's also difficult to get this kind of depth of data in the 1 minute if you're doing short term. They cost a huge amount of money, Consider that only the feed for the CBOE is $30,000 per month. So majority of retail cannot afford it, So you can, of course, but I think still nowadays, the experience of a trader beat the algo method, if you take really experienced trader.
So, with the discretionary trader side, what I always struggle with is if a discretionary trader is struggling and it's not really psychology and it's not risk management, how do you tell them to improve? Because how do they actually attach what happens in the market? How can they actually attach an edge or a predictive measure to what's happening in the market and say, you know what, we have something here, let's go for it? Are manual backtesting, or should they be using, let's say, a very strong chain of logic and reasoning about the why of a market and why basically moves happen specifically?
We can cover this on multiple strategy because it depends, Brandon. Let me give you an example. One of the swing model that I was using also in the live of BNP Paribas is it's called the earnings surprise. Let me explain really briefly for the audience what it is, okay? You have the earnings of one stock. The expectations are neutral. The stock, the earnings beat the expectation by 50%. So the earnings come bigger. What happens in the market? This is a measurable event and measurable edge. It's not something that I see different than you, different than him. We all see the same stuff, okay? Once you have this event, chain of logic, what do you expect? A big buy aggression. What's the problem when you have a big buy aggression? Slippage. Market participants are not willing to buy all in one because they will pay a huge amount of slippage on their heavy position. So in this specific case, what happens? That with a really good statistical validation, the market comes back to the gap created during the earnings surprise, and it goes back up. Okay, so you have an asymmetrical risk to reward because you cover below the gap. But in the stock market, what the stock market does usually, specifically if you are good at picking the correct stock, okay, it goes up. This event is measurable. You can take the stock, you can take the last 5 years of data, you can see expectation beating, 70% probability, okay? Drift in 60 days after the expectation, 80% of the time. Is this an edge or not? Of course. Okay, of course. And you know that this is a measurable event. But when someone trades something from gut feeling, no? Let's say, for example, what's your strategy? I wait for breakout of the trend line. Your trend line will be different than mine, will be different than his. So how I improve a strategy if what I'm watching is not the same that you are watching? It's not the same that a machine. I allow discretionality because I do analysis. But when it comes to measuring, in order flow, if at this price level there is a 500 contract executed on the Nasdaq, you can see it. He can see. A machine, if I give this data, can read it. You know? So the main problem for discretionary trader, I think it's the inability to get objective data sets. Okay. Also, let's talk about single concept. Engulfing candle, no? For price action trader. Someone consider the engulfing candle for a week above, someone with a body above. So you see, if everyone considers something different, an educator can teach you a strategy, you interpret in a completely different way, and you will be lost. And that's the reason my propaganda at the moment, okay, from where I'm public in YouTube, it's always, guys, don't trust him, don't trust me, trust him. Get the work in, take a data set, or if you are a discretionary trader, observe what happened, identify repeatable pattern in data, try to understand why they happen, okay, and then execute this edge, but execute this edge in simulation. Don't risk real money. This is the error I made. I started with a binary option. Okay, so you can understand that now they are not even, they are banned from Europe, no? But I lost a lot of money in trading trying to guess what's the correct protocol to execute something that is measurable, you know? And the biggest error everyone makes is thinking that this is only for algorithmic trader. It's not only for algorithmic trader, because also for order flow trader. If you can measure the ability of a trigger, you can improve your entry. If you can improve your entry, you can change your equity line. Or let's say an example. For an intraday strategy, if you change and you say, okay, I go to break even at 1-to-1 risk to reward, because you notice that when you enter the market, either drift or it comes back, and you save 20 stop loss, 30 stop loss per year. It's a big difference in the P&L, specifically for a strategy with not many samples, 1 or 2 per day, no?
Yeah, and you bring up a good point with your examples. And Fabio, something's always bugged me too, where people say an event is bullish or bearish, but do you think it's fair to say a signal is bullish or bearish until you have actually tested the outcome of it over multiple samples? For instance, the bullish engulfing pattern is theoretically bullish, right? But if I went and tested it across ES 30-minute chart, let's just say 10,000 times, and it has the opposite indication,
Yeah.
how do I now? I have to update the theoretical model in my mind of what this signal is. So even with absorption, right, or other order flow methodologies, what do you think? Would you not call something bullish until you run this same level of validation?
I approach the market as a spectator. I approach the market from outside. I don't bring with me my belief when I go in the market. Okay, so if the data tell me, look, actually this trigger is giving you a way better win rate if you use opposite. So when there is an absorption, the market is probably to give you a continuation, because at the end of the day, what is an absorption? A lot of pressure that cannot break one level. But if it breaks that level, you will have an acceleration. So don't use it to time the bottom, but use it to put a stop order below, wait for the breakout and accelerate. This can be useful, okay? So when we approach the market, we need to understand, first of all, that no one have the crystal ball, okay? And that data are democratic. They say the same things I say to you, to me, to Andrea, to other people, okay? So we should be guided by those, by how they reflect a behavior. And in my process, I test also signals that for the common world of trading should be opposite. For example, when the RSI reaches an extreme, everyone will expect a reversal. So you have a swing, opposite RSI, you go up. But in reality, the RSI got built, okay, as relative strength index. So it's telling you that when you go down, there is a lot of selling pressure. So you are trying to catch a falling knife, try not to get cut. And that's what I validated from multiple models. When I went through the validation of the IVB, for example, I noticed that the first assumption that I made is that, okay, let's test when we break the beginning of the range of the Nasdaq. What came to my mind is a strong candle, okay, is bringing you a bigger expansion, no? A small candle with a lot of delta is bringing you a bigger expansion. Because if it's a big candle with a lot of delta, usually the market maker and the market likes to rebalance. So you cannot cover your position immediately, you will be taken out. All this reasoning, it's really technical stuff, but if you don't spend the time to test, also manually, you will be always hiding. When you approach the market and you start with 2 words, I think that, I hope that, you are fucked. There is no way around.
So, then would you say to be a successful trader, you actually need to understand the why of what you're doing works?
Yeah.
Or can you validate a model just through rigor, statistical rigor, without really being able to explain the underlying market mechanic that is allowing the model to work in the first place?
I think before testing a strategy, you need to understand why this edge exists. For example, the stocks have an upside skew. That's the reason IVB exists and it's persistent. Okay? The commitment of traders' data force big market participants to disclose their positioning on all the assets. That's the reason the drift exists. Earnings surprise force big players to avoid slippage and to build a cluster of limit orders to get in the direction of the stock. Okay? The politician have an informational edge. If you ask me why you use this, I always know from A to B how to explain the edge to you. Recently, there was one guy, a market maker, Matteo Conti. After I came up with the video of the big trades, okay? So the study of how the MBO market data can influence price, okay? He came up with a study using 3 years of data, and he find out what I find out from experience. What he find out that if you see a big market participants, it's one operator, okay? So it's you maybe opening 500 contracts on Nasdaq. To open 500 contracts of Nasdaq, probably you have an account of 9 figures.
I won't be doing it.
Okay, so you are a big guy. This order here, from a statistical perspective, it's influencing the market 5, 10, and 15 minutes later. Exactly the time that takes me to enter a trade and go out. Okay, so I'm using this window of opportunity to get a directional bias. Of course, it's not the only thing. And remember, edge can deteriorate. In 2 years, this one can avoid existing, but I can explain why it exists. Okay, and the personal experience, like Freddy or like discretionary trader, is contributing also to the research part, because someone like Freddy with experience of a market making firm can go to a quant and can say, start to check gamma exposure levels with strong absorption with this threshold, how much adverse excursion, okay, and expansion they have. If you start to see every time you reach gamma exposure level that is in this condition, okay, you have usually 20 points of average excursion and 60 points of directional excursion in your position, you know the average risk to reward, and you know that the edge is validated. Then you need to be really careful not to go in detail about this edge, because more people, specifically hedge fund, because we are retail at the end of the day, okay? We don't have big capital. But the more hedge fund execute this edge, the more the edge decay brings the profit to zero, because they close the inefficiency, no?
So this also brings up something I wanted to know, Fabio, regarding confirmation, right? Which I have trouble understanding that that concept. But with confirmation, how do you know if confirmation is helping getting you in later? And when you're actually crafting a rule set in general for a model or a system, how do you know what pieces and parts to put together?
Nice. So I always start with the bias first, because at the end of the day, to take a position, you need to have a direction. Okay. Specifically for trend following. I do mainly trend following. Then you do one thing called edge contribution. So you take a different information and you put in the model. And you want to see if the quality of the signals improve or not. Now, I don't want to get into technical because I'm not a quant, but I have people that do this for me. So go through all the process, okay? Once you input a new information there, you can then check how the metrics change by switching. So you can put absorption, you can put aggression, you can put exhaustion, and you can test and see with this model of bias for this specific asset, which one works best. And then you need to go over what you want to do. You want to create a completely automatic system. You need to bring to platform that allow you proper testing, parameter permutation, Monte Carlo simulation, and everything. Or if you want to use the edge discretional like I do for one of my edge, I have imagine if I am at the same time the analyst, the person that execute, and the risk team. So I go up with a daily plan. This is the budget we have, guys, today. We are going to risk, let's say, $5,000 of budget today, $1,000 per trade, okay? 5 execution maximum. Worst case scenario, minus 5,000. Best case scenario, I don't know, $25,000 of profit, okay? This is the bias we are going to keep. Why? For this. Can be option flow, can be profile framing, so the structure of the profile of the volume. Okay, which trigger are we going to use? We test this. So we are going to engage in this area, in this direction, with this one, okay? I have a budget, I have a model, I have a statistical skew of why the model works. I can explain side by side why this, not this, why this, not that. Why we react to resume long on the put wall. What's the activity of the market maker there? All these things is managing to keep you in an environment where you are always the owner of the model you are executing. Because the moment you start to be the person that try to justify the model to himself, you will get lost, Brandon, because you don't know what to change when things start to go south, and things will go south because there is no trader. Also, if you take hedge fund, okay, so if you take Medallion, they have quantitative model, they have best, but they had good year, average years, and amazing years, okay? So you have a floating P&L at the end of the day. When emotions start to get in, you need to give yourself the correct reply of why you are changing this one. Okay. Why I'm removing from the execution system the absorption. Maybe for the last 3 months didn't perform good. Maybe I see that the market always leave me unfilled, so it's a waste of time. Maybe I notice that it's giving me a good execution point, but lower risk to reward. All this testing, Brandon, is why people nowadays don't want to spend time, no? Mm-hmm. So they just want to have something ready, package. I shared for free a lot of stuff. How the order flow work, how the option flow work, how the on-chain analysis work, how the swing work. But still nowadays people, even with all this material, they want you to give them the strategy that will work forever. Mm-hmm. And I live a constant fight where I say, guys, I can give you everything I know. But even if I give you everything I know, the market, it's a dynamic creature. It evolves. The market that we are seeing now with Trump is completely different from the market that we had 2-3 years ago. Mm-hmm. The market that we saw during COVID is completely different from 2010. It's a different market. Strategy that were working before are not working anymore. Imagine an algorithmic trader from a strategy created in 2010 that in the last 10 years lost money, continuing to execute because it worked in 2010. But if you think about this, this is what some retailers are doing. Mm-hmm. Why? They see that the strategy maybe it's not rewarding them, but what they do, they come up to say, but I like the strategy. It makes sense to me. And I understood something doing education also, that people always prefer simple explanation. Mm-hmm. They want the explanation of do this and that, really simple, take this demand, because they want to believe that trading, it's so easy. Drawing a line on the chart, like Brandon, let's be honest, if trading was drawing a line on the chart, watching one data set, trading 5 minutes from the sofa like they sell you in the info product space, we will not have hedge fund paying billions in research every year.
You know, Fabio, I think your answer to this next question will give a lot of perspective into what we're discussing here. Let's say you run a back test on simple model, nothing too complex. Imbalance of 300%, right? Yeah. Imbalance ratio. Gives, for whatever the trigger is, or however the top-down model looks like, great test. Mm-hmm. Validated, looks amazing.
Amazing.
We love it. But then when you flip that trigger of the imbalance to 301%, completely falls apart. Or go down to 299%, completely falls apart. Just that specific setting for the model was something that seemed to have made money in the past.
Totally overfitting. Like if you have an edge, you don't have, look, there is a chart, I don't remember the name of this chart, but it's a 3D chart that is showing you like the profitability of the system based on the parameters, okay? When you have in this chart sharp peak to up, it means that it only works in one specific parameter. Yep. If the edge is real, you should have a flat surface on the top. So it's telling you, look, this is the confidence interval from an imbalance from 250 to 300 works amazing. 400 is too much. 200 is too less. This interval. But if an edge 300 works amazing, 301 completely destroy the edge, you just find that correct parameter for an asset, and it happens a lot of time. Watching this constantly on Twitter, like vibe-coded strategy that are like equity line, sharp ratio, I don't know, 7. Profit factor 24. And I was thinking like, if you have a 24 sharp strategy, if you have strategy that have a crazy expectancy with really short amount of time execution, like on the 1 minute or the 15 seconds, you could really flip accounts at a speed that is crazy. Okay, you could really build generational wealth executing this strategy for a short amount of time. But usually what I see, then they put commission, they put slippage, and the edge completely destroy. Okay, because sometimes they just do this simple error. They forget to account for commission and slippage, and they always assume perfect execution. No 1 tick on slippage because maybe the strategy does 1 tick profit. 0 commission, 0 slippage, 1 tick profit. You can make strategy that are crazy, no?
Yeah.
The error of people at the moment and the big risk is that this vibe coding is opening the door for everyone to test strategy, no? The problem is that you need specific operational procedure to test properly a strategy. Otherwise, you risk that what you see in the vibe coded test and what you see in the real market is completely different, no? Because you don't account for overfitting, you don't account for actual market condition and overfitting. So that's the point where we are at the moment.
And another one to logically extend what you just answered. Let's say you build a thesis, put the pieces together. This is a long strategy. Just consider it bullish. Initially, completely fails.
Yeah.
But when you go when you short it, it actually, for whatever reason, works.
Okay.
How do you interpret this? Would you still abandon it even though it didn't match your thesis, but it did work on the opposite end?
It depends because sometimes you can lose consistent money for commission. So the strategy can lose consistent money. For example, I have some specific real accounts where I do testing, I pay a huge amount of commission, but this is the cost that I allow myself to then go with the hedge fund with big capital. And these are accounts where I just want to see the live execution, that if you do in a platform, you will never have the exact short-term execution accounting for slippage and stuff, no? So a strategy that consistently lose money doesn't mean that if you flip it, it's consistently profitable. It's a different topic because there are commission, there are things that are outside the strategy, okay? So I will abandon the strategy even if my thesis is correct, if I cannot find consistent edge there. Because my ego, like if I start to go with my ego and say, no, my thesis is right, and I execute something, at the end of the day, I'm shooting myself because I'm putting in a market an edge that is constantly eating. And then another problem of the portfolio is that you need to run analysis of the single model because maybe you see the portfolio going up. You have 6 models. There are 4 models performing great and 2 models slowly losing money, almost that you cannot notice, no? And you think, oh, the strategy, it's break-even, is not performing. But you can see hundreds of execution, the edge is decaying. And then in that case, you have the final proof that this strategy needs to be changed. We have a lot of history of edges like this.
Now, I did want to ask you one final question here at the table, and I have to ask. So if order flow information, as we mentioned earlier, it's the same data set telling everyone the same information, how can it still have an edge then for everyone? Or how can it still work for everyone?
This is a really smart question. So first of all, you cannot say that an edge works for everyone because an edge is composite part, okay? Order flow, it's a data set. Option flow, it's a data set, okay? Commitment of traders is a data set. The data set itself is not an edge, okay? So you take option flow, for example, with Freddy. You have all the data of the CBOE, $30,000 per month. This data alone, without the ability to process, okay, without the ability to interpret, it's useless. Because it's static data. It's like to say, look, you have all the pieces of a car. You have a Ferrari 812 Superfast here. But each single pieces that cover all the room, do you have the ability to assemble?
Well, so with if the interpretation of order flow or methodologies within it can be learned, then if it's teachable and learnable in public, wouldn't this destroy the edge as well, you think?
No. First of all, you have infinite possibility of building a signal from a data set. Okay? So if order flow was when you see an aggression buy, when you see an absorption sell, okay, if this was the only signal that you can extract, it would be useless. But a data set, I don't know if you know how many data you have inside one order flow candle of 1 minute. It's impressive. You can process for MBO, you can process for bid and ask, you can process for delta profile. You have just raw data that you can use to understand and to automate, if you want, the signal that you use in the model, okay? If only was this, but what about the bias identification, the option flow, the profile framing? It's a mix of 3-4 steps, okay, that create the strategy. And on top of it, if you execute completely algorithmic strategy, yes, there are profitable edge in order flow, okay? Just if the edge is completely quantitative and it's on the extreme short-term time frame, okay, this one can go through edge decay. Because if you share to an hedge fund, you sell the edge, I don't know, to Jane Street, with the capital that they have, they will close the edge really fast. They will squeeze all the money and then the edge is finished, okay?
Fabio, let's go over the last setup you took and how order flow can help you define bias and also potentially find opportunities.
Let's go over it together, Brandon. So Friday was a consolidation day, okay? So the main problem that people have during consolidation day, it's identifying the relevant swing. They don't understand when an impulse is finished, when they can take buy on the second one, so they usually get confused. This is a template from the deep team that they did, that is identifying the pressure area. So who is dominating? And I want to guide you from the starting of the session till the end, helping you to understand how you can refine everything here. So we open here during the session, okay? And you can see that as soon as we open on the top, this was the first drive of the opening, you see this red cluster area. This is an area where we saw previously strong absorption to the downside, okay? So the buyers tried to push, you see this triangle, they got absorbed heavy, and this area printed. So first of all, if I want to get a first confluence area of where to engage the market, this area here, for me, it's super relevant. What is the problem? The problem is that, as you can see, I don't have yet an identified swing point that starts from here, okay? So what I want to do when we are choppy, because we can see that the session started with an absorption from the sellers, we came down, and then we had an absorption from the buyers. This is what I call the cage, okay? Why the cage? Look on the right. This one was, from the beginning of the session, always balanced. This profile here is telling you that buyers and sellers are at fair value. So you don't have buyers taking control, you don't have sellers taking control. And I want always to engage when I have directional auction outside the value, okay? Because this is where you can have directional movement. The first setup that I saw is this VWAP coming here. The VWAP is the volume average weighted price. And it's where, in terms of reload of the players, you can see the maximum amount of pressure to the downside, okay? I will mark the area and then I will show you also how I reason about execution, okay? So we see that this area collapsed, and now these sellers here told you, look, these players are stronger than this player. This is pure logic, okay? The sellers took control. The next area that we had, okay, was down here. So I had all this movement from point A to point B to take my trade, okay? This one, then we go in technicals. The market reached here, this one, okay? And once reaching the bottom, you start to see that the buyers take an important aggression to the upside. This one already tell you immediately from the dip swing, okay? What's happening at the moment? The volume weighted average is engaging the price to the bottom side, and all this delta candle colored here are telling you that buyers are dominating this auction at the moment, okay? Another information that I want to show you, that when we came back here, the market went back to the value area, and you had another trade of confluence here because you are at value area low, and you see this line. This is where the buyers took complete control. This is an absorption. So the sellers tried to bring the price back, and they failed again. Let's build other contexts. I will make it even easier for you now to refine, because I will remove everything that is not interesting for us at the moment once we finish the analysis, and we will go on the delta. You know that the delta is the main force of the market, okay? So when you consider taking a position like a mean reverting from the beginning that we saw, you want to have to your side a strong aggression, okay? So you want to have on your side the sellers taking control or the buyers punching a wall. Can you see this outline of buy aggression that you had on the top? All this power was absorbed here, so they didn't add any reward, and we'll go also on this one. This one is what I call a mean reverting setup, okay? On the one of consolidation, we have, on continuation of the move, we have the same, because as you can see, the buyers are pretty aggressive at the top, but the result is zero. On this aggression here, you also had a negative candle. What does it mean? That all this buy power got absorbed to the downside, okay? And I like to use also the delta candle, as you can see, to know when it's time to put my risk to zero. Let's say I enter here with a stop loss here. When I see that the sellers take control, I put my risk to zero here. And then we go to the other setup, that was the reload of the buyers. You can see here the same. You can see a lot of pressure from the sellers, this candle here, no result, so getting completely absorbed, and the buyers taking control. Now, this one setup was impossible to take because it was the bottom side, but when they come back to test, this one is possible. You can see the sellers not making any result in this area. Now, keeping this information here, I will go to the study that I've made during the years, that is a proprietary model to understand when buyers or sellers are actually dominating the area, okay? So we remove everything else because we don't need, and we just put here the Nasdaq effort. Imagine it like this, Brandon. The Nasdaq effort is trying to simplify when a specific side is dominating the market, okay? By studying multiple forces: imbalance, absorption, aggression, and path of least resistance. So if a number of contracts, same contracts, make easier to move the price up, it means that the book is thinner on the upside, so the market can explode there. And these are my confirmation that I use for my setup. Let me give you an example. I have this area here. When I see that the sellers take control from the box, I have also my timing, this area here. So I could have tried an explosive position back to the next area here. When I come back to this area that already show me absorption, I don't know if it's visible, but you should be able to see that this is a stack of two sell control area of the sellers. This is an additional confluence that I use. And on the buy side position that we took, not the first one because it was too fast, but the second one, I have my timing and confirmation at the closing of this candle. This candle is telling me, look, it's time for you to go up. And also on position management, Brandon, how I follow my position. I trail my position below the last aggression. So I will be taken out below this low because the market, I was expecting the market to continue. It goes down and then resume. And if I want to enter, I can reload my position when we get back inside the area. But here I will be taken out from this. This is the Nasdaq effort I use. And the other one that we saw before is to identify the swing. And then we have the signature of MBO orders. I show you here. This one you can set in multiple ways. You can set with MBO data, so to see if these 345 orders were from one single market participants or were from multiple market participants. For example, Brandon, if I'm in a long position And I start to see that on this level, you have all this aggression of the buyers, but the price cannot advance. Instead of waiting, maybe I will start to trail my stop loss below the last aggression, because if this one fails, the market will reverse. If on this opposite side, on the bottom side, I start to see the buyers, okay, pushing the auction with 300 contract, confirming the auction. This is what I use when I want to trail my position, okay? So when I have in the body, probably I cover below here. Why? Because I know that this player will come to reload the position exactly there. Look at this aggression at the bottom side. Let's go to the other setup that I show you also here, how much was easy. I don't know if you can see that here. There are 111 contract absorbed on the top. So the order flow is giving you just a data set, Brandon. You need to validate it with your bias and your idea, but this kind of data have countless applications that you can make on the algorithmic and on the discretionary side. But if you tell me, I don't know anything, I don't have a bias, can I just buy, okay, a data set and be profitable? No, because it will just be the same as saying, look, I am a data analyst, I buy a data set and I become a data analyst. You need to be a data analyst before, no? And also here you can see how much aggression the market supported here. So you can see that the market was following up on the aggression, and when they came back, the buyers tried to push the auction higher but got absorbed again. So this is what I usually use, and also when I see huge contract like 167, it's a lot, and then buyers pushing on the other side, usually the market bottom down in this way, okay? Because it's a confirmation on the opposite side. Another thing that is really objective data that I would like you to take a look to is the profile, no? You can measure this in price action, you cannot. You can measure from the bottom swing to the top swing and remove the price, okay? Why this one is useful? Because we can go directly in the analysis of who is dominating this auction here. And we can see, look here, Brandon, that we have the land of nowhere, because this is balance, and then we have what it's called discount. Imagine you are in the Apple store, this one is the price of the new iPhone. If you go below, you are discounted. You want always to mark this area. So when you take this area into account, okay, this area here, let's make with the marker so it's even easier. One and this one here, we can see that we have buyer's aggression, really relevant. A lot of sellers absorb, and you have the value area low. Okay. When we go back to price, if you do proper testing, you can notice that price fill this level. And this is not for me, for you. This is just executed order. Everyone can see it, okay? So the buyer's aggression that executed from here was way more relevant than everything that happened here. So if you want to consider a buy, you want to have your confirmation, but try to use your confirmation to buy from levels that are relevant for the order flow, okay? So this one is just an additional layer that it's adding to a trader to refine the entry that he's making.
And then the entire model, as you said, on the exit side, just to clarify, this would be more of a longer position holding.
This is scalp to intraday, so it's taking short-term position to get the intraday drift, and then you can have also aggressive scalping. Aggressive scalping, Brandon, is not to take the main drift, is taking position. Let me show you, for example, I use the order track. This one is watching a different thing of the market, okay? This one is watching in each single candle who is dominating, the migration of the value area, okay? Let me give you an example. The sellers are dominating on this one. You can see this big delta, and you can see that the profile is pretty balanced, okay? Let's go on the next candle. We see a lot of sell aggression, but candle closing by, and value area still lower. When we have the confirmation that we are switching value from the closing of this value area. Why? We were in a downward drift, value area was shifting lower, value area now is switching higher. Here sellers were dominating, look here, who is dominating? Buyers. This one is what I use to load my one-to-one. So you will say, but one-to-one is not. This one is in the correct direction of the order flow with a really consistent method in risk to reward. Okay, so if you are good at understanding the main direction of the day, you can scalp every single movement in that direction. Instead of taking 1 to 5 risk reward, taking maybe 3, 4 position 1 to 1. Why it's smart this? Because even consolidating market will give you profit. When you go 1 to 5, you can stay in one position for long term. Let me give you another example. This was the first one. No? We continue higher. You can see that the value area migrate higher. The candle still green. If this idea is validated, what I expect, that the value area will protect and reload higher. So I can put my position at the value area, covering below, going for another 1 to 1. The same when I close this candle. And here it's where, I don't know if I would have taken a stop loss, but let's... No, 1 to 1, also this one that goes against you, maybe it will take your stop loss before, okay? But anyway, you have opportunity where the market is compressing and you still go to take profit, okay? Let me give you some sell example. Value is still switching higher, but here the value is switching lower. The sellers are dominating. So an example for the sell side will be stop loss above the value area high, protected, still machine gun to one-on-one. The market continue lower, okay? What I can see, that this candle close here, I take a target and I need to wait for the market to realign. This sell candle is still closed inside here. If we break below, I will make the same position. The market tell me no, we are not going down. The market flip from value area to value area high. My position here, stop loss below the value area low, I will take another 1 to 1, another take profit. Okay, look here, we switch lower with this, but it's a green candle, I don't take. We stay red, and then we switch lower, we have another position, the same logic, value area here. And then you say, can you use discretional analysis on this? Of course. Okay, so when you go inside the candle, you can read who is dominating. Let me give you a perspective on this. This is the maximum, the point of control of the candle, no? Is which lower from the previous one? Yes. What does it mean? That the value is migrating lower. Okay, perfect. What do we have here? We have the next candle trying to engage and break this level. A lot of buyers activity, zero result. What does it mean? That there are a lot of passive order continuing. Also, if the candle is developing, when I see all this absorption, I can also try to go a little bit more aggressive and squeeze a 1 to 2. Okay, but the objective of the model is not to build huge risk to reward, it's to build consistent equity and then maybe risk the equity of the profit that you made for bigger position.
And, you know, obviously with reward risk ratio and win rates have a symbiotic relationship in a sense. Obviously, higher reward risk, win rate goes down. So we know win rate isn't the most important thing. But with this 1 to 1, sometimes 1 to 2, do you have a win rate that comes with this model?
It's not always the same, but you can have also 3, 4 take profit in a row when you take a drift. Because let's take, for example, this one. You switch lower. First one position TP, second one unfilled. Second position TP, then you switch. Another position long because you switch on this one, take profit. Okay, this one stop loss, and then you start to go down. Take profit, take profit.
Of course.
So you can have a positive drift. It's not distributed, okay, but you can have a positive drift. The win rate of this model is really high. But if you tell me, would you automate it? No, and I explain you why. Because the automation don't take into consideration all the analysis and refinement of the position management. Let me give you an example. Let's say that you enter here, okay? This candle close here. The model will leave the risk here. But here I see that there is a big buyer's absorption. So I trail my stop loss and I reduce the risk to 0. When I see that the drift is sustained, like the one that we had in the closing range, I build my position. Let me give an example of position building. We flip higher, okay? What does it mean? That I can position myself here at the absorption or here with a stop loss below here. The market confirm. I take my first position to risk-free because I can cover below this aggression, and I can load another position and the extreme delta. And the market continued the reward. Then the market was closed, but in days where you have drift, Brandon, you can build 3 or 4 rolling positions with the initial risk of 1. So it's not linear, the reward, it's exponential, but there are also negative days with this model. For example, when it's extremely choppy, you can have a win rate around 40, 50%, that is break even because it's 101 plus commission. So it's not the holy grail, unfortunately.
Well, does this only work in specific markets, or would you think this is applicable?
I took the time only to test Nasdaq, but I think this is the nature of the market, how the value migrate, the actual data set of the orders. I think it can work in other markets, but I don't want to say it because I didn't do proper testing. So I don't want to spread misinformation on this one.
Right. And so then basically your answer to that also opens up that just because a strategy works one market, even in a highly correlated market like ES, doesn't mean it can just jump right over to there.
I have models that are profitable in Nasdaq and lose money in ES, and opposite. They are correlated. The fact that it's correlated doesn't mean that the microstructure is the same. This is microstructure pattern, okay? And it can be different for a lot of assets. So also people taking profitable strategy on gold, pretending that they can apply on Nasdaq and be profitable, it's just madness, because you are doing a big assumption. It's like you are saying, you have been successful in trading, so I also will be because you have been. It's not like this.
And when did you develop this model?
This model here, it's 6 months. It's got built in 6 months. Before it was not using the value area, was using only the aggression and the big trades. But then I find out that the value area is adding a lot of value. It's a game of words, but it's adding a lot of value because it's giving you how much sustain is the drift. The more the value area continue to drift up, and you see building, the more you can build your position. And sometimes it's not like this with big order because they can be distributed in all the candles. So the next candle can retrace. You see a big order here and you close. But the value area is making sure that you keep all the drift as much as it lasts. And you can see also here. These are directional moves. Then you have also these choppy moves where you give back some profit of the market. I only trade trend following model at the moment. So it's normal that when the regime is not correct and the market is just not moving, you will give some profit back of the market. It's part of the game.
Now, would you say that with a model like this, is the value area then the most important piece of this, would you say?
I will say that value area associated with delta profile, it's incredibly important for this model. And the last tweak that I add to it is the Nasdaq effort area. That is the one that I'm using also in the other model. When I have, a value migration that is going higher, and also the area telling me, look, the pressure is Q on the upside, I have all the information that I want pointing up at the same direction. Let me show you, for example, if we only filter for setup that have all the confirmation, we will take this value here, 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 and this value here. So we will take 6 trades, 5 take profit, 1 stop loss. Okay. Here, when we are migrating lower, I will only take this one, take profit also this one. So it's a confluence of information without overfitting, because the risk is that if you continue, like you know what they say, Brandon, they say, if you stress the data long enough, it will tell you what you want. Okay, and you know, because you were an algorithmic trader, so you know that if you stress, but if you go on, we go back, and you start to see how the price, these are real time, how the price react to this area, you can understand that the order flow is actually influencing the next drift on the short term, and not the holy grail. You can have really bad choppy moments. Now, this is not an example because it was an amazing buy opportunity drift. This is an example. When you have choppy money, you have an amazing sniper short, a stop loss long, but look in this moment. 1, 2, 3 stop loss that you take in a row. This is part of the market and it's part of how the market is developing.
So would you say that's the biggest, every strategy has a weak point, right? So would you say that's the biggest Achilles heel for the system?
All the trend following system suffer from consolidation regime, and I accepted it. I accept. Not blame myself where I have a consolidation week. My goal there is to protect capital.
So if there's consolidation and with this model, for instance, and obviously it's a trend following, it'll struggle a bit. This is a necessary trade-off, right? And
it's like a physiological, physiological risk for a businessman, no? If you want to run on the tourism, and if you want to run on the tourism in the UAE, you need to accept that during the summer it's hot and you don't have a lot of tourists for 2 months per year. You know it, you accept it. For trader, there are costs, there are commission. Can we be profitable with commission? Yes, but you need to have an edge that go over the commission. And this is the same for the trading space, no? And this is, of course, the impact on commission on the short term is bigger, but if you have a model that is keeping you in the correct direction of the market, you can do. And also, let me clarify this for everyone listening to this podcast. I don't want you to switch your brain off and think, okay, I will use this one. I want you to always keep your attitude of, I don't trust this model, I will test for myself, I will try simulation money, I will do my proper research, and only when I'm 100% convinced that this is an actual edge, I will execute.
Yep.
That's the best approach that you can have.
If you were going to improve this, if possible,
I'm
what do you
doing
think
a
you'd
lot
try
of
next?
studies at the moment. Like I spend a lot of money on quant research, and I'm studying bias system that take into account also the option flow pressure, the hedging activity. It will require more time, but I think I can improve this a lot.
And you said this was developed 6 months ago. How long does it actually take you to get to a validated model like this to start using?
This one, I use at least 3 years of data of testing for validation. And then the out of sample process requires 3 months of testing and watching because it's 100 of execution.
Yeah.
So in 3 months, you can collect maybe 300 trades. But still, I didn't plot this as a standalone strategy, but as proprietary study and indicators, because I always want people to use this in confluence with their model. I don't want that they abandon.
No.
I want that they use the data set to improve what they already do. I don't want that they only rely on the data set, because the big error that everyone can make is that you make indicators your god and you stop using your brain to go in the direction of the market.
No. So if someone understood the entire model and everything that we just covered and they still struggled, what do you think would be the problem they're having with applying this model?
I think that every model, if you take this for a specific moment in time, can be profitable or negative because the edge is on the long term.
Yep.
The best advice I can give to people starting is not relying only on one model. So the diversification of the portfolio and the strategy that you use. For example, I show you also the mean reverting long-term setup. So trend following, but on the long term, no? I have some days where this model doesn't perform and I have the long one. I have days where these two models doesn't perform and I have the crypto one. I will strongly disagree of relying only in one model, Brandon, because I've made countless testing and I didn't find one model that can be profitable in every market environment. So specifically, for example, if you engage prop firm, where risk constraint is crucial, no? Because if you go underwater, you can burn the prop. So you should have a diversification system or a system that at least keeps you out of the market when you say, okay, this one is not working. For example, look here. Trend following, trend following. You see that in all this area, we don't have anything because the system is built in a way where it identifies the best opportunity. Okay. And it filters out when the market conditions are not there. If you tell me, is it capable of doing this? No, otherwise I will be billionaire. If every consolidation phase will be removed and I only take directional, it will not be a system, it will be a money printer, you know?
Well, so, you know, another Achilles heel for trend following systems is the balance that comes with verifying the trend is in motion and not taking every signal that possibly comes, basically not wanting to miss the trend, but not wanting to jump in all the time, hoping to get in so early, you know? So there's always that balance with early entries with more losses, late entries, but missing the trend. How would you say that?
I have both.
Yeah.
This is my one daily shot. So it's my area of confidence to take my long position. This is my momentum model, no? So on this one, I accept that if it breaks, it's done. This is the setups of the day. On this one is momentum. So let's say it breaks this area and it continue to print area. The momentum setup tell me, Fabio, you can be here. but you can go here with this pressure. So as long as you keep a positive risk to reward and a sustained win rate, why you should avoid the setup? That's my goal. The problem is if you pretend to take a drift with a target here from the top, because in this case you are overpriced on the asset. So probably the market retrace, you close in fear, and there is all this emotional chain of errors that you can make.
So then with the trend following system, you said you take partial profits up, right?
Yeah.
And basically you take partial profits up until it reverses, you get stopped out, correct? Do you have a specific
Trailing.
Yeah, the trailing. You said you'll take at value.
Yeah, for this model here, I use 2 Nasdaq effort box to trail. So let me give you an example. Let's say that I jump in this position here, the first one, okay? The first green box. Once I print the second, I cover my stop loss at risk-free.
Yeah.
Okay? Let's say that I take this bounce. The market print a second box, I cover my risk-free. Okay? It print another box, I cover my risk below the second box.
Okay.
It print another box, okay, here the risk goes here. It print another box, the risk goes here. Print another box, the risk goes here, it takes me out here.
So it's not partial profits then, it's just trailing all
Just
the way
trailing. I tested the partial profit. The problem, Brandon, is that specifically on Nasdaq, that is an asset that can expand directionally all day, partial profit can take you out here, and then you have 200 points of rally, and these days where you have a really good rally pay out for all the partial profit that you are not taking. So it depends on the asset. If you tell me on the currency, I take a lot of partial profit because the currency is more mean reverting, but Nasdaq have a directional skew up, so it's...
Have you ever successfully deployed a partial profit strategy that uses partial profits?
No. Partial
Me
profit,
either.
no.
Yeah.
You tested on the algo side?
Yeah, it always hurt gains more than it reduced risk.
Yeah.
It always disproportionately though.
I'm happy that you validated it because manually I noticed that it's eating a lot of profit when you are right, but at the same time, when you are wrong anyway, you take a full stop loss.
Yeah. It just risk went down small, profits went down really small. So never worked for me either. But Fabio, thank you so much for outlining this model. I think for the first time, I don't think I've seen it in your content. So, and I'm happy you showed it to me and you let me ask every question I could possibly want. I know I got a lot of questions.
Thank you.
Some people like it, some don't. But thank you so much again. IQ Capital, you can start your first challenge for as little as $1. Terms and conditions apply. Check the link in the description below for more details. Built by traders for traders.